This is specifically the capital module. So we're going to be talking about investments in healthcare IT companies. We're going to be hearing from some companies that have raised capital here, and most importantly, talking about the importance of capital for growing the healthcare IT industry here, and obviously expanding outside of Georgia. I want to thank my panelists today, and also want to start off by thanking our sponsor, GE Capital. So we appreciate them stepping up today. And if you don't know me, my name is Mark Reiboldt. I am with Coker Capital Advisors. We're a boutique healthcare investment banking firm based here in Atlanta. So we advise companies on M&A and healthcare specifically M&A. I'm just going to start out. I really want to dive into the content because that's why you all are here. But before we do that, I'm going to just take a minute and I'm going to have my panelists go down the row and just briefly introduce themselves so you all know who they are, and then we'll get started. Russ?
Hi, I'm Russ Herakovich. I'm with GE Capital Healthcare Financial Services. I'm based here in Atlanta. I oversee our Southeast and Central regions. And what we do at GE Capital Healthcare Financial Services is primarily we're a senior lender. We have about $17 billion committed to the healthcare industry. Thus far this year, we've committed about $5 billion in new loans, about 130 transactions. We also do some equity investing. We actually have a $1 billion Healthy Imagination Fund that we do some of that investing through. Typically, these are investments of a couple $1 million, usually as a minority investor. A lot of times it's as a tag-along investment into transactions backed by private equity firms. Most of our deals are for companies that have at least $10 million of EBITDA. Sometimes we'll go a little bit below that, but not much, and it's kind of rare. So usually we're dealing with companies that have been around for a while. On the equity side, we'll sometimes work with smaller companies. And thanks a lot for having us here today.
Kind of between mics here. Hi, Spence McClellan with Nora Mosley Partners. We're a early stage venture capital firm headquartered here in Atlanta, focused on healthcare and IT investments in the Southeast. So obviously a healthcare IT event is right in our wheelhouse. We're usually investing between $3 to $6 million in Series A investment rounds, taking minority ownership positions in companies and working with great entrepreneurs to grow businesses. We're still very active today in investing, and made I think 3 investments this year, and 2 of those have been in health IT. And if you look across our portfolio, we have something like 8 or 9 companies in the state of Georgia. So very active and pleased to be here.
Hello, my name is Greg Schulenberg. I'm the Chief Operating Officer for Greenway Medical Technologies. We're located in Carrollton, Georgia, just down the road here. We build, sell, install, and support ambulatory software, and translated, that's physician practices and all that a physician practice touches. We're trying to bring technology, and if you were in the keynotes today, all of that wonderful collaboration, we're trying to bring that to bear in the ambulatory market.
Hi, excuse me, Jim Denny with Navicure. We're a web-based claims processing solution serving the ambulatory market as well. We sell our product across the United States to roughly 25,000 physicians. And they use our tool set to help improve the speed and effectiveness of their collections with insurance companies.
I'm Brian Carney with Harbert Venture Partners. We're a venture capital fund. I'm actually based out of our Richmond, Virginia office. We have another office over in Birmingham, Alabama, but spend a lot of time down here in the Atlanta market. We do healthcare and IT. We're currently investing out of our 3rd fund, and typically invest between $3 and $5 million initially into a company, and are usually very active. We're on the boards of all of our companies, and as it relates to healthcare IT, spend a lot of time in that market as well. So I'm glad to be down here.
Thanks, guys. Well, before I get started, I just want to apologize in advance. I'm starting to lose my voice, so wouldn't you know it, right when the event comes, I lose my voice. So I'm going to try to defer as much as possible to the panel because you want to hear from them anyway. But what I tried to do with the panel was assemble a group here of representing both dynamics in the capital process. Obviously, the company, which is raising the capital and using the capital, and then, of course, the investors, the venture investors, as well as larger equity and debt lenders. So as we continue through the conversation, I want to make sure we get a wide breadth of perspectives for all the questions. So everybody feel free to chime in whenever you want. I'll start it out with a kind of softball lobbed out to you guys and see where that takes us. Spence, just for you specifically, I don't know, who was here last year? Was anybody in this session last year? All right, so a good group. You may or may not recall one of your partners, Alan Mosley, made a comment that I think really was enlightening for the audience, and he said that...
That doesn't sound like Alan, but continue.
Well, wait till you hear the comment. No, he said that he spends the majority of his time traveling between Atlanta and Nashville, and unfortunately, he said, going to Nashville and spending a lot of time with companies there, whereas he would obviously prefer if there were more companies that you all could invest in locally. For whatever reason, hasn't been the case before. So I want to rehash that a little bit or revisit that and just kind of throw it out to you and your perspective on, what is the landscape looking like right now from an investment standpoint in healthcare IT locally, and then maybe even in the context of how that relates back to Nashville, which obviously we know has a lot of activity.
Yeah, sure. And in full disclosure, I actually moved here from Nashville. So I was, prior to joining Norma Mosley, was with a company called Healthways, which is in the disease management space for about 4 years. But yeah, and overall, to kind of hit the end of your question, I won't go into too much of a monologue, but it's actually been as most people know, a very active healthcare IT investing market, given the meaningful use incentives, given a lot of acquisition activity, which indirectly is kind of what butters our bread. When companies are buying companies down the path from us, that's how capital comes back to the start of the venture capital cycle. So it's been a very it's been a very active healthcare IT market. As it relates specifically to Atlanta and versus Nashville or whatever Alan said, Nashville obviously is very well known for healthcare services. They've done a great job with the Nashville Healthcare Council, which I was a part of when I was there. And when you're looking at healthcare companies, IT companies in particular, here versus there, we have all the ingredients here in Atlanta, more so than I would say any other part of the country. Sometimes you have to put it together a little bit more. So that's I'll explain that through a case study. An investment that Brian and actually made together in a company called Wellcentive here in town. It was a technology that a doctor up in Michigan had wanted to build, and he came to Atlanta because Atlanta had the development talent to do it. Some guys out of Meditech built the core technology. When we came in, and so they had kind of the clinical background and had the technology built. When we came in, we had all within Atlanta, found a great CEO to come in and run the business, found a fantastic sales and marketing team, again, from in Atlanta, which is a core strength of ours, and we're putting it all together and now growing the business. That is an exciting opportunity for us, and we're really happy how it came together, but it does require a little bit more of work, which maybe that's how we make our money as venture capitalists, but in piecing that all together. Whereas in Nashville, partly as a function of it being a smaller market, everyone kind of knows each other, but those things tend to kind of gel a little on their own. So you're going and looking at deals that are maybe right away venture fundable, versus in Atlanta sometimes you're going to kind of takes a while to piece it together. Now events like this are where that happens, which is why you're seeing all of us milling around and trying to meet folks here in the room. But from my experience, that's how I would kind of compare it. But we're making great strides, and I think, like I said, Nashville has big hospital companies. They don't have the development talent, and they don't necessarily have the sales and marketing talent. Atlanta has all of those pieces to make a company really work.
Yeah. Greg and Jim, I'd like to kind of get y'all's perspective on, well, both of you guys, your companies have raised a good portion of capital. I assume that includes inside maybe the region, Atlanta or Southeast, but also outside the region. Talk a little bit about that process and how you all went through that, and maybe some of the geographical variables that came up, raising capital inside the Southeast versus the Northeast or Bay Area.
We raised virtually no capital in the Southeast, so I really can't, I can tell you why we didn't. And it's really a function of where your network is, right? And so I'm from Chicago, and that's where I knew people. and that's where we raised the lion's share of our first 3 private angel investment rounds. And then in the later stages, we did a recap in '09. We used an investment banker, and that was open to all the firms in the country that wanted to participate. It just so happened that the investors ultimately were out of Baltimore. But I think the only thing I would say to that is that when we were in the early days before we were in the process of raising capital, we were obviously interested in talking to a number of the private equity and venture firms. And I would hear, there's no investments in Atlanta from a lot of people, but as a practical matter, we had 65 or 70 private equity firms come down here on a regular basis, and the guys from Sequoia flew in on their jet. So, to say that there's not a lot of stuff going on here, I think what you sort of weave those 2 points together, you need a really strong network that's very approachable for early days of an entrepreneur, because they're starting out, they don't know what to do, they don't know who to approach. They're probably the strongest believer in their idea, and yet, it's kind of hard in the early days to go pitch that. So, that's the important part, right? The fabric for people being welcomed into an easily approachable environment. And then I think, you got to get the investment money flowing, so, the money comes back to the places where it was successful, right? So the companies that were invested in Chicago, that creates some wealth, and then those investors go back into the market, probably in Chicago. And I just think we need more of that in Atlanta. And I think once you start the ball rolling, and I think that's probably in large measure what Nashville has, is they've had a lot of success doing it serially. And that's really what builds the foundation for the sort of the rejuvenation of the network. That's a lot from somebody who knows nothing about it.
Yeah, and for Greenway, we were a bit odd in this respect. We raised most of our early money privately, so we sold private stock into the company or from the company. So we were fortunate enough to be able to do that to the tune of about $50 million. So starting a company that way is a bit odd. There was a predecessor company that was successful, and that allowed for a success story in seed money. When we decided to go out and take investment money, and we were in a growth strategy, and that was a different conversation. And the thing I remember most about it was you really only have to ask once, and then the firms came. And we entertained bids or conversations from local groups. I think we were talking earlier, local groups, and then really all around the country. I think more importantly for us, it was about the personality of the firm. So there was availability, but what was the personality of the firm that were offering these funds? Because they're going to have to live with you. They're part of your board most of the time, and you're going to be spending a great deal of time with them. So that was more important to us than really the regionality, I guess. And it was more important than or at least as important as the finances.
Russ, I want to go to you for a second and looking at companies, maybe a little bit larger segment, up market a little bit in terms of size and stage. Comment a little bit about, in this post-recession world, how that perspective has changed as you guys are evaluating equity or lending scenarios with healthcare IT companies, not just here, but all over.
Well, there's a lot of different ways to look at it with that question, I guess. From a lending standpoint, we've found it to be a great market for us. A lot of the competitors that we used to have are gone or a lot weaker. So we've definitely picked up a lot of market share, so it's benefited us greatly in that regards. As far as the impact on these companies, I think you've got more employed people, so you've got fewer people with insurance, which are impacting a lot of healthcare service providers, and that's negatively impacting their business. I think everyone's trying to find ways to be more efficient, and healthcare reform is certainly driving that. And healthcare IT is obviously a big part of a way a company can be more efficient. And I do think you're going to see a positive impact on the business and the sector and really help it grow.
And then, Brian, as you guys are looking at earlier stage venture deals, I know you guys are real active in the Southeast region, in this market. What are you guys looking for these days?
We've spent, I'd say, majority of our time within the healthcare practice. Most of it today is focused on healthcare IT and healthcare services. We'll do some devices. But that's not, that's a pretty common theme, right, for a lot of groups. I mean, we are constantly reading articles on what's going on in the venture industry and what's happening, and if you've read any of those, you certainly know that, funding into medical devices and into, drug development organizations has fallen off pretty dramatically, not surprisingly with what's going on with a lot of the regulatory issues and getting products approved. And so we've seen a lot of capital that used to be allocated there shifting towards healthcare services and healthcare IT, and so I think that bodes well for a lot of startup companies, particularly in this region, because I think there will be capital coming your way as you look for opportunities. That's certainly where we've been spending a lot of our time.
Go a little bit deeper on, you mentioned healthcare services versus healthcare technology, excuse me, and that's definitely a distinction that we've all probably heard or used in the past. What are your thoughts, and anybody can speak to this, but what are your thoughts on how that has maybe come together in the past few years, or maybe even separated even more and become more distinctive, separate subsectors?
Yeah, I mean, they're definitely distinct. I mean, we see companies that are purely what I would call healthcare IT, and then some that are just purely providing a service, right? And then some of that, and I think there's attractive sides to both of those, but I think there is a hybrid that kind of emerged, and telemedicine is one that comes to mind, right? Where you're still doing, you're still providing a service in a lot of ways, but it's kind of a technology-enabled service that you're doing remotely, and it's, I think where you see them really come together, right, and then the major focus is obviously reducing healthcare costs while improving the patient outcomes. And so I think that's where you see them come together, and that's where we've seen a lot of opportunities to invest capital in companies that are trying to solve those issues by pulling both services and technology together.
I was just going to add exactly what Brian was saying. I think that the line is blurring a fair amount, and you're seeing a lot of what now people call tech-enabled business services, just a cute way of putting those together. And it's being driven by a lot of the things we're all talking about. From an investment standpoint, I think a lot of the times we bucket people who are taking frontline reimbursement exposure as services, and people who are kind of providing infrastructure and support to those people taking the brunt of the frontline reimbursement issues into more of the health IT bucket. And I think that's where you're seeing a bifurcation in the investment healthcare services, i.e. those taking the full brunt of the super committee, whatever oxymoron that is, and other things going on in reimbursement and with Obamacare there's a lot more uncertainty there. And so you're seeing some slowdown in investment in those categories. Although there's alternative delivery models, et cetera. You're seeing all the hype and the frothiness almost on the IT side, providing support, infrastructure, technology to the actual providers and payers on the front line. So in general, that's, from a business model, it's coming together. From an investment standpoint, that's kind of how we've separated the two out, if you will.
But it does seem like it's sort of in the early stages. I mean, there's a lot of good examples. One I look at a lot is home health, where there's very few home health companies that are actively utilizing telemedicine, and it's primarily because CMS doesn't reimburse for it. And the home health industry will tell you they're close to getting CMS over that hurdle of trying to figure out a way to reward them for utilizing telemedicine. But today, it's not happening. I mean, you talk to the biggest guys out there, the Gentivas and the Medicis and stuff, they have extremely small telemedicine products or groups, and they're just not utilizing it. And the technology's out there, and you kind of have people who are really good at the IT component and people who are really good at the services. And I think in some cases they've struggled to bring those two together. And there's a big upside and a lot of opportunities still out there to bring those two together and help really gain the true upside from the technology.
Yeah. In the earlier panel this morning, it came up, they were talking a little bit about the possibility of the government implementing or injecting more of an FDA approval process into the healthcare technology development continuum. And so, what's your perspective on that? If we go down that route, how does that change that dynamic at all, or does it, or does it change the risk profile for you from an investment standpoint, and maybe even from a development standpoint? How do you guys approach that?
Well, I mean, just thinking about it in the context of protecting patient or health records, right? I mean, we do that in the process of processing insurance claims. Greenway, obviously, in the course of just the physician interfacing with their software from a clinical perspective. And if you look at the releases of the times that those security protocols have been breached, they've been pretty significant and they're pretty sizable when they happen. Somebody leaves a laptop with 500,000 patient records on it, right, on the subway or something like that. And they're just now starting to address that. And so obviously on one level that's really important, but on another level, if you think about interoperability is one of the biggest challenges we face in the dissemination of healthcare IT. Everybody's got their own stacks and they keep them very tight from top to bottom. And it makes it very difficult for people to, interface with different products and services. And really, for me personally, I think that's probably one of the biggest hurdles to the advance of best-in-breed products, right? You can't get connected, you can't obviously offer your product. So on one level, you need those standards, but if you make them too strict, then all of a sudden you're going to constrain people's ability to interface with one another. So I don't know what the right balance is there. It's obviously necessary, but I can see in the early days probably more of a hindrance than a help.
I would agree with that. Just starting a software company and having some run before there was any regulation, if you will, any outside group looking in at your products, that was very advantageous to us. Now we have meaningful use and CCHIT, and you have, a standard out there and someone looking over your shoulder. Well, we've seen what that does to smaller companies. They've had a hard time keeping up, and we're coming out with the second phase of meaningful use. We've got CCHIT, which is still pushing these, and all of these things are good, but it makes the small company struggle a bit more. And quite honestly, that's where a lot of the innovation comes from, is the small companies. So it scares me to death to think the FDA is going to get involved and really regulate to that level that it pushes it all the way down to the innovation decisions. That's very scary, and I think it should be for any small business owner that's trying to innovate.
And just to add on to that, I think one of the answers that came up in the session earlier was around this Southeast Bio conference last week, and there was a medical device panel there, and there's actually a lot of focus. I think medical device right now can be a case study in a lot of ways, and how you can, kind of stall innovation with too much regulation. And there were a couple speakers there who were investors who said, look, we're doing all of our product development, all of our manufacturing, all of our approval work ex-US. We're not even going to build anything in the US. We're going to put it all in Ireland and other places, get it approved over there, CE mark, and then sell it before we ever even have to worry about, bringing it into the U.S., which is very discouraging as you think about, innovation within the U.S. and within the healthcare field in particular. And so now that was, one or two data points. I'm not saying that everybody's doing that, but I think it's a pretty good case study. And when you put so many roadblocks up, people find other ways to get products approved and to sell them. And he had a great case study of, and they weren't all his deals, but 12 to 15 companies that got bought purely off CE mark approval, and they never had to deal with the U.S. approval. And so when you hear things like that, you do get worried that if they start focusing on other industry, you could run into some of those roadblocks that will kind of stall out innovation for a little while.
Yeah, I think of the current administration as the regulation administration, and it worries me, and I would encourage you to fight back if you feel like they're putting more burden on you. And one example I always laugh about is there was this hospital company that we lend money to that they had imaging equipment that a chip was missing from, and it had stored on it images and patient numbers. And there was nothing else, and there was no way to tie, names to the numbers. And these were colon images. And so their lawyers advised them that they had to send out letters to all the patients who had had their image of their colon stolen to advise them that this medical record had been lost, because that's the way the rules are written, and just, to protect the patients. So, I mean, it's out of control in many regards.
Yeah, I think that's right. I was talking to a couple financial sponsors, and their answer was, in the last 12 to 18 months, they've even transitioned a little bit away from, if they did before look at, traditional life sciences, biotech, companies that truly were FDA involved. So, maybe healthcare services, healthcare IT was a diversification or spreading out some of the risk strategy for them. This would obviously change that. What about and Spence, I think you may have referred to it earlier, but the reimbursement impact, and when we consider what all the changes and the uncertainty, and nobody knows what's going to happen from an investment standpoint, how are you guys looking at that reimbursement as a risk variable?
Well, I mean, again, with that bifurcation between kind of the services or those that are getting directly impacted, it clearly increases the risk, and you got to take that into account. But I think someone else was saying too, that also is creating a lot of opportunity. Providers and payers both being focused on driving greater efficiency, providers being reimbursed for quality measurement. That's something that people have been talking about for a long time, and I think the silver lining with a lot of this regulatory and legislation is that there's finally in place, look, we are going to start paying you next year for reporting the clinical outcomes, and then in 2 years we're going to start benchmarking you and you're going to get paid according to those. I mean, that's the kind of stuff which finally gets people to start opening their wallets for a lot of the quality measurement and analytic platforms that are out there. So yeah, on one hand it creates a lot of challenge, and you got to take that into account. And then even back on the services side, I mean, I think there are opportunities for changing the payment system. I think that was a consistent theme on the last answer, was everyone was kind of silently bemoaning the way that healthcare is reimbursed right now. And reimbursement cuts will keep cutting and cutting and cutting, and ultimately maybe that gets us to more of a system of bundled payments or more quality measurement payments, and that's where I think at least we need to go. So in the short term, it may still hurt people starting up new health insurance plans. We had a investment that was just sold earlier this year in a dual eligible special needs plan. That is where healthcare needs to go. It was coordinated care, using PHRs, using field nurses to manage people who are both in the Medicare and Medicaid population. Huge improved clinical results, savings for the state of Massachusetts where the plan existed, and in one fell swoop of the pen earlier this year, our value, while still great, took a pretty big hit. So that kind of stuff hurts, but I think what's fun about being early stage investors is you're trying to apply where you think things should go to the decisions you make in investing, and I think there's still some great opportunities. So,
Greg and Jim, this isn't directly capital related, but I think it's relevant to the discussion. The trend of, and there's multiple names, clinical integration or alignment, the trend of hospitals and physicians coming back together, aligning through very formal and informal affiliation models. Has that changed your business model, or maybe how you go about executing it in the last few months or years, and how do you kind of see that going in the next couple of years?
Well, I think it has. Again, some of that is where we are in the spectrum as a company, but we certainly see physicians merging with one another and then actually selling practices into hospitals. That's probably cyclical. I think if you look back over time, you see that that's happened before, and they break off and run their own practices and merge and that sort of thing. So we do see it. We try to solve everything with technology and service, so our thought towards that is to give tools and service that work in any environment. But we are seeing it, and we do have areas within our company and people that specialize in those areas. So whether it's a loosely held hospital situation that owns several practices, or whether it's, like Dr. Morrow, the one physician practice, we have to build tools and services that service them both. And I don't think you're well served if you choose one or the other. So that's been our thought. I definitely see it as a trend right now, and but not something to get too bent out of shape about. Really,
Mm-hmm.
it's natural, I think.
I've answered exactly the same way. You only did better.
What about working with investors after the deal is done? Talk a little bit about that. You guys have raised capital, and you guys sit on boards and work with your partners that are running the companies. Talk a little bit about that dynamic from both perspectives.
So we, as I mentioned earlier, we had private investors in the early days of the company, and for the most part, they left us alone, and thankfully we were able to execute against our plan. But when we went to raise capital, it was at a point in the company's life where we really thought we would benefit from the advice and counsel of a wise private equity firm. So we ran the process, we selected them, and we like to say we hired them. And I think, then it's just a function of how good a job you did in terms of who you chose. And we're very pleased, and it certainly changes the dynamics in the early days. You have a lot of freedom, and then all of a sudden you've got somebody you're reporting to on a more consistent basis. But that's an easy thing to overcome. And they corrected some things that we needed to do better. They made some calls that probably weren't right, but like any marriage, once you get to know one another, then things work out pretty well. So I would say, we're pleased, and it's, it's just the next stage in the evolution of a company.
I told these guys I was going to be asked this question, so no, it's. I said earlier, the personality of the group you're dealing with is very important because you're going to have to live with them. And for us, as Jim said, we got a lot of good out of it. Now, they're all different deals, right? And one of the things that we dealt with early was from our competitors. This is a small group in a small town, and they're going to go out of business. As a matter of fact, they said that the line was they do their business out of a mobile home in Carrollton, Georgia. So they really just tried to push us down to the lowest form of business you could have. So getting a partner in that had legitimate financial backing was important to us. And when we talked to our potential customers, these guys were on the phone many times to say this is actually a growing business and they're going to be around for a long time. So that's an intangible that we got that I'm not sure that 99% of the people out looking for that kind of capital think about. And the other thing we got was it was just a room full of entrepreneurs, if you will. And we ran the business accordingly. We had IT guys, we had innovation guys, we had really smart people that could build software. But we brought this capital investment in, and with it came a financial mind and a discipline at the time we probably didn't have. So there was very definitely an upside. And the downsides are very logical, right? Now you're answering, at least in part, to another group that many times are not entrepreneurial, but we found the marriage there, and that's important, and that's why I think the personality is just as important as the numbers, actually.
And that's exactly what I was trying to say with my very first answer to the panel. I'm already getting text messages from the Nashville Chamber of Commerce thinking I was bashing Nashville. I was trying to say it can be a little more challenging in a larger market that has a lot of great talent to make those connections. And I think in the example I gave with Wellcentive and other investments in Georgia, I'd like to think that's where we can be helpful as far as building the best possible team. From working on the board, I think we're great. We're great partners. I've heard Harbert's really difficult to work with, though, so you may want to talk to Brian about that.
So I was going to chime in with a similar comment, but no, I think we actually do invest with them a lot, and they're fine. But I think you've heard it. I mean, the marriage thing is true. I think what we always encourage entrepreneurs to do, and what we try to do on our side, is just get to develop a relationship early outside of the traditional fundraising process. So you really get to know the management team, and they get to know you. And I think it's better for everybody. I think as you move later into the cycle of a company and the more of the private equity space, I think you can do more of the auction type fundraising deals because a lot of the business has been institutionalized at that point. But in a lot of the deals that we come in on, whether it's a Series A or a Series B, there's just not a lot of the formal reporting in place. There's a lot of changes that need to take place. And so at that point, I mean, we're probably having monthly board calls and some, monthly meetings at some points. And so it really is. I mean, you're not part of the management team, but sometimes it feels like it. And so particularly in those early stages, we really do, encourage people to find the right partner because they're going to be really involved with you, through those next, whatever it takes, 3 to 5 years.
One thing I'd add, and when you're trying to find the partner, I really think it helps to have a good advisor, an investment banker, or someone who can help you shop it and make sure you're negotiating the best terms for the management team. There can be a huge difference in how you structure a deal and at the end of the day, as far as what kind of payout you see, finding that relationship that works for you and fits. That's one great reason to maybe go with someone who's local because, someone from the Southeast, you might be more comfortable with them and you're around more and so forth, and you can build a stronger, better relationship potentially. But you definitely want to shop it and do a nice job. And it's not necessarily form over substance, but an investment banker can help you do a good job of putting together a nice package to sell your story. It's just like cleaning up your house before someone comes to look at it. And I've certainly seen some companies make mistakes and have a bad marriage where they got in with a private equity firm that just didn't work out that well. and it's tough to go through a divorce and try to figure out a way to get out of it once you're into it. So it's a very big decision, something you need to be very careful with, and you shouldn't rush into. You really want to shop it and make certain that you've got the right partner, and you consider different scenarios of how things might go. You know, how much money do they have left in the fund, and you know, are there additional capital be put to work? What advice can they give you, and you know, what connections do they have that can help, and are they going to add value being on phone calls? Do they have certain expertise? Do they have other names in their portfolio that you're going to be able to leverage to help you? So it's a huge decision. You want to be very careful with it.
Russ, does it change at all the dynamic, whether you're looking at a pre-EBITDA company versus maybe, like you said, you know, 10 million in EBITDA and up? Those are very different segments. So is the dynamic working with management teams and boards, is it pretty much the same approach or mindset?
No, it's certainly different. I mean, I've always believed in the life cycle and evolution of a company, and that they change, and that typically, you know, the CEO of a startup is not going to be the best CEO when the company's much larger. I mean, there's certainly exceptions to that rule, but you know, you're just going to have to use a different type of investment banker or advisor. It's not going to be Goldman Sachs for a pre-EBITDA company kind of thing, but you can always get someone to help you and you know, shop it around and make sure you find the right partner.
Okay. Well, I have plenty of questions here, but I did want to open it up to the audience. So if you guys in the audience have a question, please raise your hand, and I'd like to take some of your questions. Right here.
Yeah, so these are more for the investors. You talked about after the marriage. But what are you guys doing to incubate rather than just watch multiple incubators? Do you have programs in place to generate ideas and put your teams around them? Start with Ryan.
You mean in terms of just trying to figure out the next early stage companies that maybe aren't investable yet, but just trying to figure out?
So just to find and incubate the idea from the beginning. There's tons of ideas out there, obviously. But are you proactively searching the market?
So maybe taking it from the napkin to commercialization. Or
Yeah, no, you know, it's funny, we don't have a formal, you know, incubator process and all that. There are some funds recently that have done an idea, which is one we've kicked around, we haven't done it, where you take, you know, say you have a $200 million fund, you carve off $5 million, right, and you use that as kind of your early stage seed capital, and you maybe sprinkle around $250,000 to $500,000 in some of these more incubator type projects, which I think is a pretty interesting approach that some funds have done, right, because as everybody knows, the capital, some of it's gone very early and some of it's gone most of it's gone very late, and so where there's a gap in the market today is in some of those ideas that need that, you know, period of growth and need that $500,000 to $1 million. So I think you've seen some funds do that, which is an interesting approach. You know, we haven't done that today. Frankly, we haven't had a large enough fund to really do that, but we've considered it. I think what we do more is we just try to, I'm out of Richmond, right? I mean, we, in our local market up there, we see entrepreneurs all the time with great ideas, and what we do is, if we really like the idea, we help them, you know, think about their plan, how to develop their plan more completely, and then we introduce them to angels and people we know who do that type of investing, and we basically try to help them through that process and help them raise that early capital. We help them think about how to structure the capital so that it's attractive when it does get to an institutional level, and so we do a ton of that kind of across the region, and frankly, as I mentioned earlier, it's you know, it's not all, you know, because we're just really nice people and like to spend our time that way. It's because ultimately we hope that they grow into a successful business that'll hit our stage and we can develop, you know, we can invest at that point. And so I think it's again, that's another way to kind of develop that relationship early and figure out if you work well with the teams. And we do a lot of that, you know, in our local markets, of trying to put them in touch with people and get them, you know, that first $2 to $3 million or whatever it is, $1 to $3 million that they need to kind of get to more of an institutional investment level.
Yeah, I'd agree. I mean, we're you know, not a huge fund, so we don't have an in-house incubation program. We work very closely with a lot of the groups here in town, the ATDC, the Flashpoint, a lot of the groups like those and other parts of the market we invest in. And then, as I was saying earlier, though, I think the biggest part of our job really is building out our network. I mean, a lot of times the second or third question I ask somebody that I meet from McKesson or certainly not, you know, Navicure or Greenway, because they're right here next to me, but do you have a non-compete? And can I come hire you from one of our companies in next year? Because I have a guy with a great idea who really needs an operator or really needs a technology lead. And that's frankly in-house, most of the work that we're doing to help those ideas come to fruition.
This is to the investor. What does the incurred patent process
So intellectual property.
Yeah, I mean, we're not doing a great deal. We're doing no life sciences investing, and we've got one or two med device deals, but not many, and those are mostly post-FDA. From an investment philosophy standpoint, back on the IT and services side, it's nice to have the patent, but the market's moving so much, and there's this window, particularly in health IT, going on right now of market share grab that we'd rather have a business that's leaning more on its business model and its competitive differentiation and its features than it is on patent protection. There are investors who that's a big part of their strategy is fighting patents and having that first to market. And it's clearly an issue if we're investing in a company that's facing a competitor with a strong patent portfolio. So I don't mean to discount it completely, but we actually it's not very high on our criteria, I would say, particularly in the areas we're investing.
What about the proposed changes in the patent process, trying to speed it up?
Yeah, again, I still don't know. I read articles on both sides of the table that it's going to improve or could have some adverse unintended consequences, but it's just not that high on our scale. I don't know, Brian, they do a little bit more.
Most of the stuff that we see, if IP is important, it's already past the point where a lot of them have either been issued, and so it's not something that we're typically focused on in our diligence process. It's either already gotten there or there's enough risk where we'll have to assume that it might not get there in our investment time frame.
For Jim and Greg, has the Stimulus Act and the subsequent legislation and discussion of healthcare reform that's taken place, has that changed you all's outlook on partnering with financial sponsors, raising capital, going out to the market for alternative forms of capital, or even maybe the next stage in your growth procession?
Well, for us, it's been really quite helpful, actually. I mean, what we do is we work with practices typically when they're upgrading all of their IT, and in many cases, Greenway will be being considered at the time. So, what the Stimulus Act has done is made it essentially mandatory for all the practices of all shapes and sizes throughout the country to get an electronic medical records product. And so for the last 10 years, our bread and butter has been bigger practices that had, more sophisticated management, more capital resources. They've already made that transition in many cases. But what's happening now is 1, 2, 3, and 4-man groups, they're all coming into the market. And it seems like it's a wave for us right now. So I think on that level, it's been good. And there's not only a clinical improvement from adopting that kind of software. I mean, what Greenway sells versus what somebody might have bought 10 years ago is just revolutionary. But it also helps to improve the administration of the practice, and that's where a lot of practices are falling short in terms of collecting what's owed to them. So it's been very helpful for us.
Yeah, Jim and I have similar answers because we work very closely together, and I really couldn't say it better. We've seen everyone getting in the market, whether they're whether we ask them directly if it's because of stimulus or not. We tend to understand that there's dollars out there, and that's why they're getting into the market. We're seeing fewer early adopters, which means that some physicians and caregivers feel like they have to get into the market with EHRs and EDI services. So if they feel like they have to, they many times require a different level of service. So that's been a bit different for us. Just ramping up that level of service for those non-early adopters. But we've definitely seen the push, and we're very thankful for it. But then there's the next phase of that, which is now can we solve this problem? And right now this problem is I want to communicate with the guy across the street who's on a different system, and that's where the collaboration comes in. And I'm hopeful that these stimulus dollars will continue to push that collaboration.
For you investors on the panel, as we're wrapping up, is there any one particular area or focus or kind of sub-specialization within the health IT world that particularly excites you? I know it's you may not even want to mention at this point, but
For me, it's
give
easy.
us a hint.
I'm enamored with
Electronic medical records.
I think telehealth is going to be huge. I'm convinced that there's just a tremendous opportunity. I look at One story, I look back, when I got out of grad school, it was 1994, I was working at a bank, and virtually no one had a cell phone. And I remember by the end of that decade, almost everyone had a cell phone. I'm convinced that within the next 5 years, almost all phone conversations are going to be over the video phone with, you look at the Apple and Skype and things like that. And I just think the consumers are going to start demanding the ability to talk to doctors and nurses over video conferencing, and that, if you're throwing up all night long and you wake up in the morning, do you want to drag yourself into the doctor's office, or would you rather just be able to get on your computer, explain the problem, and drive through the CVS drive-through and get your medicine and go back home? And it's just, there's so many reasons that it makes sense that telemedicine has to take off. And you look at the demographics and the aging of the population, that the first baby boomer turns 65 on January 1. I mean, there's going to be huge, huge demand, and we've got to become more efficient at taking care of these patients. And just telemedicine, the use of computers and videos and so forth, there's tremendous upside potential.
I just think, and again, listening to the presentations this morning just reinforced this. There's all this talk about ACOs, and we joke about them, and are there already private models out there? Are they going to work? The final rules, it seemed like were responsive to a lot of the concerns, but there's still a lot of question marks. Regardless of whether ACOs, as currently constructed by CMS, are going to remain intact or work, I think a lot of the underlying themes of ACOs are hopefully here to stay. Things like quality measurement, interoperability, population health management. So those are all themes that we're tracking very closely and looking for investments in. And then another theme that was again mentioned this morning, it's always nice when people are consistent, but is consumerism in healthcare. Mm-hmm. And I think coming from a disease management company which was very focused on payer customer, but was being paid to engage with consumers and had a lot of challenges doing so, all this consumer engagement talk is going to be very difficult unless you're looking at it through the lens of the consumer. And I think there's a lot of technologies and delivery models that are breaking that down and taking that perspective from the ground up, and that's pretty exciting to see. So.
Yeah, no, I think I was going to add. I mean, consumerism is really one of those. We think of where we spend a lot of time is looking at different technologies where you're either putting more data in the hands of the consumer, right? Whether it's around doctor selection, physician selection processes, getting them more involved with that process, down the line to using technology like iPhones and things to track personal data, right? So that when you show up at a physician or you scan something to a physician, you have more data points than you ordinarily would. And so there's a lot of things around this where I think it's just getting the consumer more involved and kind of actively tracking their conditions and trying to reduce some of the costs associated with these chronic conditions. And so I think we certainly spend a lot of time in those areas. I think Spence is right. I mean, it's where it's going. And so there's certainly a lot of different angles and ways to attack that.
Great. Yeah, one more question from the audience. So.
Yes. In line with this, in terms of what niches you see coming before you for possible investment, I know certainly cloud computing and virtualization are all of us. And now we're beginning to see talk of the private cloud that's going to be behind the wall. I know there's certainly will be issues in terms of how do we still maintain an open architecture and interoperability. Are you seeing proposals that deal with niche ideas or niche developments, specifically for virtualization and cloud computing, and specifically, are you seeing anything in Georgia?
I think every pitch I see says virtualization and cloud these days. So I mean, it's certainly like the theme. I mean, I haven't seen anything around the private cloud. I haven't seen anything in Georgia specifically focused on that personally. I don't know if you guys have. But.
Well, yeah, the quick answer is absolutely. Nationally, and in fact, we've seen several companies focused on providing those cloud computing services, both private and public, specifically to healthcare organizations, I should say, because of the issues with HIPAA and security and the natural kind of lag sometimes with healthcare organizations to move into new technologies. Here in Georgia, I think what's interesting is you're seeing, you heard Tino talk about it earlier, we have a very strong backbone in information security here in Atlanta. And we've talked with several companies who have a legacy in more broad-based IT security that are trying to carve out verticals in healthcare and are either doing it through spin-outs or entrepreneurs coming out of those companies and doing it themselves. So we see that as a great opportunity for the city of Atlanta and Georgia to take those two, where Georgia leads initiatives and blend them together. So.
Great. Well, I'm getting the signal that we've reached the time limit, so let's give these guys a hand. And we greatly appreciate you guys participating.